Gold has a long history of holding its value. Unlike paper currency coins and other assets, it has maintained its value through times of economic uncertainty. The US dollar is no longer backed by physical gold and silver. The dollar bill started out as an assurance of real money, meaning gold and silver. The original banknote stated, "This note is legal tender for all debts, public and private, and is redeemable in lawful money at the United States Treasury or at any Federal Reserve Bank." The dollar bill today states, "This note is legal tender for all debts, public and private," meaning the paper money is the currency and is no longer representing real money. In other words, the cash has no value for itself and is only backed by the goods and services in the economy. Inflation is when the general prices for goods and services increase and the purchasing power of the dollar falls. If inflation becomes too high, it forces people to dramatically decrease their use of the currency. This causes acceleration in the inflation rate, which has a negative impact on the economy and hurts its ability to supply goods. Known as hyperinflation, this increase in inflation can lead to the abandonment of the use of the country's currency. Gold is a powerful hedge during times of hyperinflation because its value tends to rise when the cost of living increases. Between 2002 to 2007, the price of gold more than doubled from $347 an ounce to $833.75 an ounce. That's because the dollar's value fell 40% during that time period. During the financial crisis in 2008, investors continued to hedge against the decline in the dollar caused by the Federal Reserve's quantitative easing program and the record-level deficit spending, which drove the debt-to-GDP ratio above the critical 90% level. Gold prices continued to rise in response to the Eurozone crisis, the impact of Obamacare, the Dodd-Frank Wall Street Reform Act, and the 2011 debt ceiling crisis. As a result, gold prices more than doubled again, from $869.75 in 2008 to a record high $1,895 in 2011. Deflation is a decrease in the general price of goods and services. Deflation occurs when the inflation rate falls below 0%. Deflation increases the real value of money over time, which increases the purchasing power of the currency, allowing one to buy more goods and services than before with the same amount of money. This also means that the real value of debt is increased and can have a negative impact, especially if the deflation was unexpected. During times of deflation, business activity slows and the economy is burdened by excessive debt. The greatest example of deflation was during the Great Depression during the 1930s. On October 24, 1929, the stock market bubble burst and the investors began dumping their shares. 12.9 million shares were traded that day, known as Black Thursday. And 5 days later, another 16 million shares were traded. Millions of shares ended up worthless, and the investors who purchased these shares with borrowed money were wiped out completely. During this time, consumer confidence had diminished, and the consumers had drastically decreased spending and investing. This downturn had led to factories and businesses closing their doors. Investors began running to their banks demanding deposits in cash, forcing banks to liquidate loans to make up for their lack of on-hand cash. Gold, on the other hand, was continuously rising. $1 invested in the Dow just before the Great Depression fell to less than 50 cents by 1935. The same dollar invested in home-stake mining soared to more than $5.50. Gold retains its value not only in times of financial uncertainty, but in times of geopolitical uncertainty. Investors often aim towards this traditional safe haven when world tensions arise. During such times, it often outperforms other investments. For example, gold has soared in value ever since Britain voted to leave the European Union. Prices have reached a 3-year high as Brexit worries intensify. The metal is now worth a quarter more an ounce than it was in the end of 2015. The demand for gold is constantly increasing as gold investing is becoming continuously more popular. The overall global demand of gold has reached 4,050 tons in the second quarter of 2016, which is a 15% increase compared to the same period last year. In many countries, gold is intertwined into the culture. The jewelry market accounts for 55 to 60% of gold usage. For thousands of years, gold jewelry has been used to mark special occasions in the Chinese calendar, from Chinese New Year to the Mid-Autumn Festival, weddings and birthdays. Gold was the color of the emperor and is associated with good luck. China, being one of the largest producers of gold, still needs to import large amounts of it to satisfy the ever-growing demand. The key to diversification is finding investments that are not closely correlated to one another. Gold has historically had a negative correlation to stocks and other financial instruments. Gold tends to go up when everything else goes down. It gives investors insurance against geopolitical events, uncertainty, and inflation. Properly diversified investors combine gold with stocks and bonds in a portfolio to reduce the overall volatility and risk. Gold should be an important part of a diversified investment portfolio because its price increases in response to events that cause the value of paper investments such as stocks and bonds to decline. Although the price of gold can be volatile in the short term, it has always maintained its value in the long term. Through the years, it has served as a hedge against inflation and the erosion of major currencies, and thus is an investment well worth considering.